So you're squarely in the middle of all of this. It's a great place to start our event here today because you're investing around some of these principles, right? Climate, social responsibility, but you're also trying to make money and returns for investors. And my question to you is, do those two things go hand in hand right now when we're in the middle of a bear market and the priority for investors really is profits, cash preservation, not necessarily some of these ESG policies?
Well, Sarah, thank you for that question, and it's great to be here with everyone. We think about investing as, this is something that you can do for the very short term, but for the vast majority of asset owners and even retail and wealth investors, people are investing over time. They're looking for very strong economic performance over time. And so we built engine number one because we think the market sometimes gets confused about investing only for ideology, or the market gets confused in investing extremely short term. So what we have done is we look at a company's primary business, we look at the material impact areas, and we take that into account and we go deep with companies. So an example like the move from internal combustion engines to battery electric vehicles, that's a change that happens over time. It's complicated. There's a way to do that where you understand consumer demand, you understand material impact on climate, and you can work with the company to help the company win and be very successful.
Well, you mentioned your mission statement. Nobody ever heard of engine number one until, what was it, early last year. With a 0.02% stake in ExxonMobil, you fought management in a proxy battle and somehow won 3 board seats on this issue of climate policies and sustainability. How did that happen?
Well, from an engine number one perspective, we actually think of it as a campaign that was about governance and a campaign that was about long-term capitalism. And so the work that we did with Exxon was our principle of investing, which I talked about before, is to look at how companies change and how they need to change through big systems transitions. So as investors, sometimes we like to talk about Google and Amazon. That's great. But if you think about where value is really going to be created in the next decade, we've got an energy transition. We've got changes in how people get to work and use cars and transportation, changes in agriculture, and so forth. And so we simply looked at Exxon as an investor. And we said, if Exxon is smart and has the right capabilities from a governance perspective on the board to manage through an energy transition, because we use energy and we're in transition, and also to look at how the business has value after that transition, that's great for financial shareholders of Exxon. So we were able to do that and bring a lot of other investors with us.
And you convinced the big institutional shareholders. Yeah, no, that was what was so impressive as a fund that many had not heard of before. So what's the update, Jennifer? How has Exxon been doing since that battle was won May of last year?
So from a proxy perspective, the work that we did, and investors came with us, was to add some additional capabilities to the board to help Exxon manage capital allocation and to develop additional businesses over time. And so Exxon has done those things. They've been disciplined on the capital allocation side. They've set clear targets and made progress to those targets from an emissions perspective, which gives them credit and a social license to operate as they move forward. And they've also started a green energy business. And on the back of the work that we did with Exxon, and this gets to this, we believe that investors need to be active owners. We continued to do work across the energy sector and worked with a number of great companies that have set clear Scope 1 and 2 targets and actually agreed to third-party methane verification. And for people that care about climate, you know that methane matters. And so being transparent, being audited across different energy companies is a big step forward. Whether you're a financial-only investor and you need that data to look at the company's risk and the company's value over time, or you're interested because you're interested in impact at scale and reducing these emissions.
I guess what I'm wondering, Jennifer, is that Exxon has done remarkably well in the market up a ton since you got in, but a lot of it is because oil prices have spiked and there's a war with Russia cut off from a large part of the market, a major oil producer. So is ExxonMobil a good long-term bet from here on some of these ideas about sustainability?
I would say if you look at the appreciation of different companies in the energy sector, the work that we did with Exxon, their stock was more than doubled, was significantly higher than any of their peers. So it wasn't oil prices. It was actually the improvement in their governance. And then another good example is Occidental, which has been a leader in the space. of transparency, emission, working on green businesses, their stock was up more than 60% the first half of the year. Again, different than peers. So, we believe that these are fundamentally investment issues. And at the same time, if as investors we're working with companies, this is good old American capitalism, or working with these companies to create value and have appreciation in their price over time, at the same time, you're holding these companies if you are worried about impact, and you're quantifying the emissions, and you can work with the company to turn it down as you go through time.
But still, I mean, a part of it has to be the fact that we need fossil fuels right now, and we need them desperately, and Europe needs them even more right now. So what is the right balance to think about the future of some of these energy companies? I mean, clearly, Oxy also Warren Buffett has been buying, so that's been a big help. But clearly, some of these companies find themselves at a crossroads where they're being asked to produce more oil and also to shift toward a more sustainable position for the future.
Yeah, I think that's right. And we talk about it as an energy transition. So engine number one is looking at these very complicated systems transitions. And we are in an energy transition. Thanks to the war, the transition probably is a little bit longer. So what does that mean? It means if I'm an investor and I care about sustainability, I mean, I have a choice. People use fossil fuel. We haven't made the transition. We as a society haven't done that yet. And so if we need fossil assets, we need them to be managed by the big companies in the most responsible way possible. And we need these huge engineering and development companies to also apply resources where they can, where and only where they'll be financially rewarded for it over time, to look at new technologies and how do these companies maintain value after that transition when we're in more of a renewable environment or carbon capture environment. And potentially, some of these companies can be winners in that space as well because they know how to do these things at scale. So definitely think about it as we're in energy transition. How do you be responsible and run a business to deliver energy to the world, which we need today? And then as you get to the other side of that transition, how do some of these great companies have business models where they can participate and they can still have value over time?
How much of your portfolio right now is energy company?
We have as a business, we think about it as you can hold the market, and we think that there is some improvement that could be done in the index or passive side of the market. So one business we have is simply an index fund. If you're going to hold an index, we think you should be active and use the votes to drive these great long-term economic outcomes. So in that product, energy is the same. Excuse me, Sarah. Energy is the same. Energy is the same percentage as the index, and then we have another ETF. It's active. It's concentrated. That holds primarily energy, transportation, and ag stocks because we think that's a part of the portfolio that is underweight for the vast majority of investors. And you need these active themes to participate either in value creation in these industries, and as you participate in these industries, to do it responsibly.
Okay, I'll give you a break to clear your throat, Jennifer. Hopefully you have water there. But my next question, I've seen you quoted lately saying that you're not necessarily always going to take an activist stance, and you actually want to get away from the activist moniker, even though, as I mentioned, Exxon, the proxy fight really helped put you on the map. So I'm curious where your focus is and where you see the biggest opportunities and how you're going to engage from here.
Yeah, we learned from the Exxon campaign, I think, is that we think the market is ready to have a conversation about economics. And so we don't need political theater on either side. We need to actually work with the biggest public companies in America, as the capitalist system was set up to do, to take material impact areas into account. And if you think about it that way, and you think about it as aligning how the companies have higher value over time, as well as how they can quantify and address their major impact areas, it becomes extremely constructive. So the work we did with the other big energy companies after Exxon that I mentioned, around 3 more companies joining oil, gas, methane partnerships, that was very constructive. We do a lot of work with the auto sector. We've talked very publicly about GM, and GM's a great example where supporting them on making this transition, which is long-term, it does not take only a quarter, that is good for GM, and that's good for the financial investors, and that's good from an impact perspective.
So is GM a better play on the EV transition than Tesla?
It is. They're both. I mean, they're both plays. Would be our opinion. And what we see in a lot of portfolios is that people know about Tesla, but they have forgotten about GM and they've forgotten about Ford. And so our sort of theory about this is if you leave your money in a passive index, or you're only buying the kind of super growth stocks, you've got a huge problem in your portfolio, because we're going to see all these transitions happen in the coming decade, and they need to happen at scale. The market wants EVs, battery electric vehicles, and the market is going to switch. And from a scale perspective, that's 20, 30, that's millions and millions of cars. I mean, Tesla's right here. And so there's huge room for an incumbent like GM and for Ford, frankly, to be part of creating and meeting all of this demand. And when they do that, the winners are going to be still Tesla, but also the GMs and Fords, and then all of the other companies that are enablers as they build their businesses.
Is there another example, another company that you can share with us that you think is doing a good job in leading and maybe underappreciated?
Oh, I think if you think of it very crudely as, who's doing a good job on governance, who's doing a good job on their business is very sensitive to climate, they're doing a great job, and then the same can be said for workers and wages. We think the vast majority of companies are actually trying to get this right. We have more data. We have more data on the climate side today as investors, as engine number one, but the whole market has really great data on scope 1 and 2, and we'll get there on scope 3. So that can be quantified, and we can show financial causality, and when a company deals with a risk in a smart way, their value goes up. We see this in the ag space as well. Or go ahead, Sarah.
Oh, no, go ahead. I'm please want to hear some examples from you.
Yeah, and I was going to say an example is in the ag space. An example of a company that we think is getting it right is Deere. So Deere makes tractors. We think tractors are dirty if we have our impact hat on. But if you flip it and you think about how do we solve the food crisis globally, Deere is a company that does precision agriculture. What does that mean? It means the tractor helps you manage water and fertilizer. What does that mean? It means it's better for the climate, but it also increases yields and money and financial performance for the farmers. And so there are a lot of examples of companies that we think are totally on the right path, where they're building a business, they're solving these huge systemic problems that we have. And it's also from an impact perspective, you're doing a better job. And then in the consumer space, there are companies like Walmart. It's a great example that has been working on how to understand the supply chain and optimize supply chain and be able to describe everything that happens along the way. And that puts them in a great perspective, because as consumers want to understand that, consumers want good practices. They're able to understand the whole chain and explain that to consumers.
Will you guys launch another proxy fight anytime soon?
Well, if we would, we probably wouldn't talk about it publicly. But joking aside,
I'm just wondering if the strategy, where it fits in.
No,
for you.
our strategy is to be constructive. We think there's a lot of room to work very constructively with companies on these different issues, and really effectively, as investors, be long-term investors and support these companies on solving supply chain issues and bottleneck issues. And frankly, for a lot of North American companies, particularly on the manufacturing, transportation, logistics, we're going to see a huge resurgence in production and manufacturing in the United States. This is great for impact, but it's going to create a huge amount of value. And again, in a lot of portfolios today, thematically, the portfolio isn't holding railroads. You're not assuming cars get made in the U.S. You're not assuming chips get made and assembled in the U.S. And so we will do something. In the future around this opportunity to really invest in the U.S. supply chain, as well as all the work that we're doing on climate, as well as the work we do to just continue to work with companies through the proxy voting process. So no plans to do an activist campaign, but definitely we will continue to be very active. We think you should always, as an investor or a manager on behalf of others, be very active with the companies that are in the portfolio.
No, it's very interesting about the supply chain. So Jennifer, right before we came on, I don't know if you saw the clips of some of the fierce backlash against ESG, woke capitalism. I'm curious what you make of that pushback, which only seems to be increasing politically.
I guess the way that we would think about it is, systems change is complicated, investing is complicated. And so as investors, which we are, as opposed to politicians or anything else, we really think you have to understand these systems and companies at a very deep level to make good choices. And so investing shouldn't, our point of view at engine number one is investing should never be ideological. Investing should be about understanding these companies, understanding how the industries are changing, and working with the companies on their material areas of impact. It's financial, and it all ties together. So hopefully we don't let theater get in our way on some of this. We move towards looking for, we have good data, we can use data to make investments, we can have transparency, and we can get away from some of the theater-oriented debates and focus on value creation.
Well, on that note, I did want to ask you about BlackRock, because that's where you come from. You helped, I think, found the iShares business, and I'm curious what you make of BlackRock's strategy versus your own strategy, what the big differences are, especially in light of some of these news tidbits like we got this week with Louisiana pulling $900 million out of BlackRock funds because they say that BlackRock's policies are harmful to Louisiana's energy economy.
Well, I think as from an engine number one seat, I'm not in a position to comment on other people's practices or policies. But what I would say is large companies with many existing businesses, it's harder as an incumbent to pivot and to make everybody happy and to change business practice, which is why for us, we think we need new entrants as well, like engine number one, where we don't have a huge number of businesses. We're able to have a very simple principle of we use data, we use it to invest, impacts are a big part of that, and we're entirely transparent on everything we do, including every single vote every year. It's a little easier for us as a new entrant to the market to do that than not just one, but many of the larger asset managers where it's a little bit more complex for them.